Can I get a hardship withdrawal? Well, in this video, I'll go over the what is, how to, and the taxes on the hardship withdrawal. And if you stay to the very end, I'll give you some strategies and the updated new strategies after the CARES Act coming up. Aloha everyone, my name is Matt Ragudo. I'm a chartered retirement planning counselor, and I've been helping individuals navigate their financial future and help them attain financial independence. For more resources on retirement planning topics like this one, please consider subscribing to my channel and check back here for more videos from time to time. Before we dive into today's topic, I must disclose as a financial advisor and financial professional that myself, my affiliates, and related parties do not provide investment, tax, legal, or accounting advice. The material here prepared today is for educational and informational purposes only and should not be relied on or taken as investment, tax, legal, or accounting advice. You should always consult your own investment, tax, legal, and accounting advisors before taking any transactions. All right, so what are the hardship withdrawal rules? The IRS determines the hardship as immediate and heavy financial obligation, and the amount necessary is to be taken from the 401k, and that's all you can take. It must be exactly the amount that is sufficient to fulfill that need. The need can be for both the employee and or a spouse and dependent. For the exact language that the IRS uses, please see the link in the description below. One important note is that if you do have other assets available that would be able to cover this hardship, then you must exhaust all those assets before you can take a hardship withdrawal from the 401k. All right, so how do you take a hardship withdrawal from the 401k? In other words, how do you show proof? Unfortunately, it does depend on the plan that you're in. Most plans, because they don't want to get too creative, will actually do what's called the deemed necessary rule. In other words, all the things that were in that link down below, those are all things that are acceptable for that plan. So quick tip, for those of you folks who have an IRA, that's an individual retirement account, you actually don't have to file for a hardship withdrawal of any kind. You will always have access to that money inside the IRA because it is 100% controlled by you. There are early withdrawal penalties and tax implications when taking those up, but that's for the next section. If you guys are finding value, you learned something today, hit that like button for me, will you? Thanks. 401k withdrawal tax. So up until now, we didn't really go into any kind of actual tax implications when taking any kind of withdrawals. So here's one thing you must realize, that the 401k, if it is a standard deferred 401k, then you'll have to pay gross income tax on all the money that you withdraw. In addition to that, you will also have to pay a premature distribution penalty if you are under the age of 59 and a half. The IRS does give us extra provisions though, in order to waive that 10% early withdrawal penalty. The IRS has a table that I have linked in the description below, but it basically comes down to death, disability, or unreimbursed medical bills that exceed 10% of your AGI. So because of the CARES Act that took place in 2020, people who have a COVID-19 related disaster or hardship actually have a little bit different provision when it comes to the 401k. Many of you may know this or may not, but the 401k actually has a loan provision. And in this loan provision, you can take up to $50,000 or 50%, whichever is lower, in a form of a loan. And this loan is, number one, not taxable because it is meant to be a loan. You have to repay it. So that is the distinguishing factor of a hardship withdrawal and a loan, is that the loan has to be repaid. You don't have to file for any of the hardship or anything like that. You simply contact your plan sponsor, let them know you want to apply for a loan or try and go through the loan process, and they will tell you what you need to do. Now, going back to what I said about the COVID-19, if you a spouse or a dependent was diagnosed with the COVID-19, you are qualified as a COVID-19 hardship withdrawal or hardship loan provision under the CARES Act, which means that your $50,000 loan maximum is increased to $100,000. Now that also all follows those same rules on vested account balance, 50% of the balance, or whichever one is less, right? So 50% of the account balance up to $100,000, depending on your account balance you have with the 401k. The second thing you can do is if you have hardship due to the COVID-19 in the employment section. So if you are unemployed, furloughed, or your company somehow shut down, your loan amount does increase again. But before you utilize any of what I said in regards to the CARES Act, check with your plan sponsor, because a lot of them right now are struggling to figure out how they can mark these loans as a COVID-19 loan. Be sure to check with your plan sponsor, the 401k administrator or investment company before doing any of that. So with these stiff penalties and problematic provisions of the hardship withdrawal, most times this would be your last resort. Always look to the plan loans on the 401k before thinking about the hardship withdrawal, and always ask your plan sponsor or the 401k administrator on what your plan offers you in the case of accessing your money early. So I hope today's video helped you understand what the hardship withdrawal is, how to take it, what the taxes are, and potential other ways to access that money in your 401k. For more planning tips like this, consider subscribing and like the video if you found it valuable, and we'll see you next time.